Hello everyone, in this video we're going to be going through the fair value option. Excuse the writing here already, I had to redo this video, but either way, what is fair value option? Well, fair value option is a relatively new financial accounting concept that allows companies to use fair value as the basis of measurement for certain assets and liabilities. Okay, so what does that mean? That means that when a company is going to value an asset or a liability as of a certain date, like let's say they're going to value it as of 12/31 of 2017, okay, if they look in the market and the fair value is $100 for the asset or the liability or whatever it is, then on the balance sheet, that asset or liability is valued at $100. That's basically what it means. Okay, so we're using fair value itself to measure the asset or the liability. Okay, so companies may elect to use fair value options for certain financial instruments. Well, what is a financial instrument? It's something like a notes receivable or a bond payable, things of that nature. Okay, that's basically what a financial instrument would be. Those are some examples. And now companies elect fair value option on an instrument by instrument basis, meaning that if a company had 5 notes receivable, they're not going to elect fair value option for all 5 notes receivable as a whole. What they're going to do is that they're going to decide individually, okay, I want to use fair value option for number 1, okay, by itself. And then I want to use fair value option for number 4 by itself, okay? It's individually elected for each individual notes receivable or whatever financial instrument you're using, okay? It's not elected as a whole for all of the notes receivables or all the bonds payables that you have, okay? Once a company elects fair value option for a specific financial instrument, it is irrevocable for that instrument, meaning that the company cannot take back the election. Once they've elected fair value option, they must continue to use fair value option for all years going forward after the election is made. And the election is made when the company first acquires the financial instrument. Okay, so when they first get the notes payable or they first issue the bonds payable or whatever it might be, then that would be a situation where they've acquired the financial instrument at that point. That's when they can elect to use fair value option. Okay, and they must use it from then on. Okay. So how fair value option works? Well, first the company decides which financial instrument it will elect fair value option for, okay? And then after they've elected fair value option, basically after that, at each balance sheet date, the company must determine the fair value of the instrument and mark it to market. Market to market meaning, you adjust the fair value of you adjust the carrying value of the instrument. We'll see in just a second what this means in numbers, but we adjust the carrying value of the instrument to the market, okay? That's what it means to mark something to market, okay? So if the carrying value is $100 and the market is $120, well, marking it to market means that we increase the value of the instrument to $120, okay? And then any gains and losses are reported in net income as an unrealized holding gain or loss. We'll see what that looks like as well. And then when marking the financial instrument to market, the company directly debits or credits the financial instrument. Okay, so we actually, if we're using a notes receivable, we'll debit or credit notes receivable directly. If we're using a bond payable or something like that, we directly debit or credit bonds payable. Okay, quick example here. XYZ company has a notes receivable for $500,000 from Tanya, one of its most loyal customers. XYZ company elected to use the fair value option with respect to this notes receivable. Okay, as at December 31 of 2016, the fair value of the note receivable was $520. Okay, and then at December 31 of 2017, so at the end of the next year, the fair value was $480. So now we need to prepare journal entries for the year ended December 31 and then the year ended December 31 of 2017. So 2016 and 2017 is when we need to prepare the journal entries. Okay, so for 2016, how did we get this journal entry? Well, the way you want to think about this is you want to just make a T account and then you want to figure out what the journal entry is going to be. Okay, so we know that we start off with a balance of $500,000. It just gives us that for 2016. We started off with $500,000, and then we know that we want the ending balance to be $520 because it's telling us the fair value is $520. That means we have to debit notes receivable for $520, right? Because we're going for $500 debit to $520 debit, we must debit notes receivable for $20,000. Okay, then the credit is always just going to be this UHGL-income, unrealized holding gain loss-income. Also abbreviated UHGL-income. That's generally fine for most professors. Obviously ask them, make sure, but most professors are fine with you using something like UHGL-income there, okay? And that's basically the journal entry, okay? So what we want to do is we just want to figure out what's the change in the balance in the notes receivable, and then whatever the change is, the debit or the credit that we need to make up always just goes to UHGL, okay? So if it's an increase in this case for notes receivable, because it's an asset, right, we have a gain, right? If the notes receivable goes up in value, that means we have a gain, right? So we have to debit notes receivable, and then we have to credit the gain, okay? Then we have a situation where we have our notes receivable again, okay? And as of the beginning of the year, it would be 520, right? Because as of the end of last year, right, when we just did it, we saw that it was $520,000 at the end of 2016. And then at the end of 2017 tells us that's 480,000, right? So our ending balance would be 480,000, which means we must have to credit notes receivable in this case for $40,000, okay? And then you just post that to your account, to your journal entry, which would mean that you would just credit notes receivable for $40,000, and then the debit has to be again to UHGL-income. In this case, it's a loss, right? Because it's a debit. Our notes receivable went down in value, and so it's going to be a debit to the loss, okay, and a credit to the notes receivable. So that's the end of this video. The only other thing, I guess, is, again, marking to market, just to review that really quick in more concrete terms, I guess, is so as an example, we start at 500,000 here, and then our market value is 520 here. So to market, it means that we just increase the value here. And then at the end of the next year, right, we start at 520, we want to end at 440. So we just credit notes receivable for 40. Okay, that would be marking it to market. Okay, reducing or increasing the carrying value to reflect the market value. Okay, just stating the notes receivable at the market value. So that's the end of this video, and I hope that was helpful.